So what price should you be paying if you're going to buy a stock? Do you buy just at the current price or do you wait for a better price? So in this video, I'm going to go over two methods that I've used in determining when's the best time to buy a stock. So I'll first talk about the method that I used to use when I was more of a value investor, which is just a simple calculation. It only works on single individual companies. It doesn't work on ETFs or anything like that. But the second method that I actually use now, which I feel like is a better method, is you can use that on anything, individual stocks, ETFs, anything that has a stock price. So I'm going to assume that you already know what you want to buy, you've done your research, and you've got a list of all the companies that you want to purchase. You're just not sure when to purchase them or in which order. So let's go over the first method. This is a method I used early on in my investing journey, and it's more about trying to find undervalued stocks and buying at a price that is lower than the earnings per share figure. So it's just a simple calculation of 16 times earnings per share and finding a price. If it's trading below that price, that means it's an excellent price and you want to buy. A lot of investors will use a similar method to this to try and find cheap stocks, but I feel like you only use this method once you've already found a good company. It's not to be used solely on its own. It's only to be used once you already have a list of companies that you already want to buy. You don't want to buy a company simply because it's undervalued. You want to make sure it's a good company first. So here's a list of the ASX 20, the top 20 stocks in Australia, and how many of them are currently trading below 16 times earnings per share. As you can see, it's a lot of the material stocks right now because the price has fallen due to iron ore prices. So a lot of them are currently trading below 16 times EPS, which many people would consider undervalued. Now, overall, I actually think that this is kind of a flawed strategy though. I used it very successfully for quite a number of years, and it was what I was using to try and determine what price to pay, but I was willing to be quite patient and wait a long time. But there's often times that a company will never fall below 16 times EPS. Some companies just never go that low. Even when there's a crash or a dip, they just never fall that low. And there's other companies that are constantly under the 16 times earnings per share and they never rise again. So they're never going to make that value back in the future. Sometimes cheap stocks are cheap for a reason. So while I did use this method quite successfully in the past, I do think it's a flawed method, and it doesn't really take into account how long you're going to have to wait for that price to dip. It could be that it never dips below that price, and it could be that you're just waiting a really, really long time. And most investors don't want to wait like a year, 6 months to buy a stock that they're interested in. So now I use quite a different method. It's more based on looking at the chart. So I guess it's kind of, you could call it a charting method. It's basically looking at the individual company or the fund and seeing its patterns. The types of patterns that you want to look for is, does the company seem to rise at the start of the month? Does the company seem to fall in the middle of the month? Those sort of things. It isn't as precise. You don't get an actual figure like you do with the first method, which is a lot more mathematical. This is more goes on gut feel and what the price is likely to do within the next few weeks. So I'll look at the chart over the last 3 months when I'm determining what price I want to pay. I always change the chart to a candlestick pattern. I just like the amount of information that you get with that because it shows both the opening, closing, and the high and low prices for the day or the week, whatever it's charting. In most charts, you'll also see that there's a line running through it. That's the moving average. A lot of traders use this line to determine what movement that the company or stock is going in. So they might buy once it hits up, goes through the moving average, moves up over it, and they might sell if it moves back down over it. It's just a simple way to see the overall movement. I don't pay it too much attention, but it's nice to have. The first thing I'm looking for is just the general direction the company is going. Is it going up? Is it going down? Is it going sideways? Here in this example, Aristocrat is trading upwards. So I'm also looking for a pattern of rises and dips. So some companies have very strong patterns in such that they rise at the end of the week, for example. But Aristocrat doesn't have any strong patterns, although it does seem to dip slightly at the start of the month and rise from the mid to the end of the month. So that's really good to know. So right now, Aristocrat is trading at the highest it's ever been in the last 3 months. And so for this reason, if this company was on my watch list, I might hold off right now. I would prefer to see it fall slightly. I prefer to see a dip before I purchased. Now, as you can see, over the past 3 months, Aristocrat has been as low as $40.76 on the 5th of August, and it hit a high of $49.39 on the 21st of October. So if I wanted to get in quick, I think a good price would be around $45 for Aristocrat. It's very likely to hit that within the next few weeks. and you could buy at that price quite comfortably. It also means that you're not waiting forever and you're not likely to miss out if it's a company that you wanted to buy. I'll give you another example with Wesfarmers because that shows different patterns. It's actually trending downwards right now, but from research, let's say that you wanted to buy this particular company. It does look like it's coming up a little bit right now, but that could be temporary. It's hard to tell. I think it's trading at a really good price right now, but you might want to see if it falls to about $56, I think. There's a good chance that it might do that within the next week or so. Now, the charting method isn't a perfect method either. It takes a lot of guesswork and a lot of trying to figure out where the price might go, but it does mean that you can get in a lot quicker. You're not waiting for a company to be considered undervalued. And because now I'm buying more for the dividend rather than the stock price, I still want to buy at a good price, but I'm more concerned with getting that so I can start getting dividends, start getting income. Another thing I like with the charting method is that it can be used on anything that's listed on the stock exchange if there's a chart involved. So that means not only individual companies, but also funds, anything, ETFs, LICs, anything like that. That is generally how I find a price for the company that I want to purchase. It's basically just generally looking at the chart, seeing the general direction of the company, and seeing what it's likely to do in the next few weeks based on what it's already done in the past. If it's moving up, I'll keep the price that I want to buy at fairly close if it's rising, because otherwise I may not get into it. If it's falling, I might wait for it to fall even a bit further. It really depends on what it's done over the last 3 months. So this one's more on gut feel and trying to get a better price than the current price rather than some mathematical formula like the first method. Anyway, I hope you found this useful. I hope it's given you some thought on what price you want to pay rather than just paying the current market price, giving a little bit more thought to trying to get a better price or waiting for a dip or the price to fall just slightly, just so you can get that little edge. Anyway, happy investing. Thanks so much for watching the video, and I'll see you in the next video. Bye.